There's an old saying in business that I've learned to be absolutely true over my 40 years building NVIDIA. Never waste a good crisis. Right now, while most investors are panicking about the escalating Israel-Iran situation, asking themselves whether they should sell everything or buy defense stocks, I'm seeing something completely different. I'm seeing one of the greatest wealth transfer opportunities of this decade. And I'm going to tell you exactly how smart investors, the top 1%, are positioning themselves right now to get significantly richer, while everyone else is making emotional decisions that will cost them dearly. This isn't about politics. This isn't about picking sides. This is about understanding how markets actually work during geopolitical chaos and using that knowledge to build generational wealth. Let me show you the playbook. Before we dive into the specific strategy, I need you to understand something fundamental about how I think about crisis and opportunity. When I started NVIDIA back in 1993, we faced multiple existential crises. The Asian financial crisis in 1997 nearly destroyed us. The dot-com crash in 2000 wiped out most of our competitors. The financial crisis in 2008 could have been our end. But every single one of those crises became an opportunity for NVIDIA to gain market share, acquire talent, and position ourselves for the next wave of growth. Why? Because while our competitors were playing defense, cutting costs, and retreating, we were playing offense. The same principle applies to geopolitical conflicts and market volatility. When tensions rise in the Middle East, when countries start threatening each other, when oil prices spike and defense stocks jump, 90% of retail investors do one of two things. They either panic sell everything and go to cash, thinking they're protecting themselves, or they chase the obvious plays like oil stocks and defense contractors, buying high after the initial spike has already happened. Both strategies are equally terrible. Both will leave you poorer than when you started. And I'm going to prove that to you with hard data in just a moment. The top 1% of investors, the people who consistently generate life-changing returns, they do something completely different during times of crisis. They follow a systematic approach based on historical patterns that repeat themselves with remarkable consistency. They understand that human psychology doesn't change. Markets react the same way to geopolitical stress today as they did 20 years ago, 30 years ago, 50 years ago. If you know the pattern, if you understand the timeline, you can position yourself to profit massively while everyone else is losing money out of fear or greed. Let me share with you the framework that I use at NVIDIA when evaluating how to position our investments during geopolitical crisis. It's based on three fundamental pillars: history, sector analysis, and strategic positioning. We're going to walk through each of these pillars in detail, and by the end, you'll have a complete blueprint for how to not just survive this Israel-Iran situation, but actually thrive and generate significant returns over the next 12 to 18 months. And yes, at the end, I'm going to reveal the one stock that I believe represents the perfect combination of defense exposure and technology growth, a true unicorn that almost no one is talking about. Let's start with history, because history is the most powerful tool in an investor's arsenal. The biggest failure of our education system is that schools teach history as a boring collection of dates and dead people, when in reality, understanding historical patterns is literally worth millions of dollars. If you know what happened the last time a similar situation played out, you have a massive informational advantage over everyone who's reacting emotionally to current events. Here's what the data tells us about wars and markets. Over the past 50 years, we've had numerous major geopolitical conflicts. The Gulf War in 1991, the invasion of Afghanistan in 2001, the Iraq War in 2003, the Russian invasion of Georgia in 2008, the Crimean annexation in 2014, the Syrian civil war, and most recently, the Russian invasion of Ukraine in 2022. Every single one of these conflicts followed the same pattern in the stock market. An initial panic sell-off, followed by a bottom within 30 to 40 days, followed by a strong recovery that takes the market to new highs within 12 months. Let me give you the specific numbers because this is important. Over the past 50 years, the average drawdown on the S&P 500 after a major geopolitical conflict started was 6.4%. That typically happened within the first 10 days. The panic was real, the selling was intense, and portfolios dropped significantly. But here's what most investors miss. After 35 days, on average, the market was back to break even. And after 12 months, the S&P 500 was up an average of 9% from the pre-conflict level. Think about what that means. If you sold at the bottom out of fear, you locked in a 6.4% loss and missed the entire recovery. If you bought at the bottom, you captured a 15.4% gain within a year. Now, some of you are thinking, well, Jensen, that's 50 years of data. What about more recent conflicts? Haven't markets become more volatile? Haven't things changed? Great question. Let's look at just the past 30 years. From 1994 to 2024, we had 70 major conflicts around the world. 70 wars in 30 years. That's more than 2 wars per year on average. The world is a far more chaotic place than most Americans realize because we live in a relatively stable bubble. During those 30 years and 70 conflicts, the S&P 500 went from around 450 points to over 5,000 points. That's an 1,176% return, or an 11.3% compound annual growth rate. The NASDAQ went from around 750 points to over 19,000 points. That's an 1,170% return, or a 10.9% compound annual growth rate. Let me say that again. Through 70 wars, through countless geopolitical crises, through periods when it felt like the world was ending, both major indices delivered approximately 11% annual returns. The markets literally did not care about wars. This is the single most important lesson I can teach you about geopolitical investing. Wars create short-term volatility and long-term opportunity. The volatility scares out weak hands who sell at the worst possible time. The opportunity rewards patient investors who understand that chaos is temporary but economic growth is persistent. At NVIDIA, we've used this principle repeatedly. When COVID hit in 2020 and markets crashed, we didn't sell. We bought. When Ukraine was invaded in 2022 and tech stocks plummeted, we didn't retreat. We accelerated our investments. Every single time, that decision to lean into fear rather than run from it has been incredibly profitable. Now let's talk about the second pillar, sector analysis. Because not all sectors perform the same during geopolitical conflicts. Understanding which sectors benefit in the short term versus the long term is critical to positioning your portfolio correctly. This is where most investors get it completely wrong. They see a conflict in the Middle East and immediately think, I should buy oil stocks and defense contractors. That seems logical, right? Conflicts in oil-producing regions should drive up oil prices. Increased military spending should benefit defense companies. The logic is sound, but the execution is terrible, and I'll tell you exactly why. Let's start with energy stocks. Yes, oil prices spike when conflicts erupt in the Middle East. We saw this with the Gulf War, we saw it with Iraq, we saw it with the Arab Spring, and we saw it most recently with Ukraine. When Russia invaded Ukraine in February of 2022, oil went from $91 per barrel to $130 per barrel by March. Energy stocks rallied hard. Everyone who bought oil stocks in February and early March made money. But here's what happened next. By December of 2022, oil was at $70 per barrel. Anyone who bought oil stocks at $120 per barrel got crushed. The spike was temporary. The crash was brutal. This pattern repeats itself every single time. Oil spikes on uncertainty and fear. The moment there's any sign of peace talks, any indication that supply chains won't be as disrupted as feared, any hint that the conflict might be contained, oil prices collapse. They don't gradually decline. They fall out of an elevator. If you're a short-term trader who bought oil stocks before the spike, congratulations, you timed it perfectly. But if you're buying now, after tensions have already escalated, you're probably the sucker at the table. You're buying high from the smart money that bought low and is now selling to you. Defense stocks follow the exact same pattern. When Russia invaded Ukraine, Lockheed Martin was up 32%. Raytheon was up 22%. Everyone was talking about how defense stocks were the safe play during wartime. But look what happened 12 months later. Lockheed was flat. Raytheon was flat. The initial spike evaporated completely. Why? Because defense budgets don't change that quickly. Government contracts take years to negotiate and implement. The market prices in the expected future defense spending immediately, and then when that spending materializes over years instead of months, there's no catalyst for the stock to keep going up. For short-term traders, energy and defense can be profitable trades if you time them perfectly. But for long-term investors like me, they're distractions at best and traps at worst. The opportunity has usually already passed by the time retail investors hear about it and decide to invest. The smart money bought weeks or months before the conflict escalated. They were positioned for the spike. By the time you see it on the news and decide to buy, they're selling to you. So if energy and defense are short-term trades that we should avoid, what should we be buying? The answer is technology. And I know what you're thinking. Jensen, you run a technology company. Of course you're going to say buy technology, but hear me out, because the data is overwhelming and indisputable. Technology stocks are always the worst performers in the initial panic sell-off during geopolitical conflicts. Investors flee to safety, they reduce risk, they sell their most volatile holdings, and tech stocks get hammered. But technology stocks are also always the best performers over the subsequent 12 to 18 months. Let me give you concrete examples from recent conflicts. When Russia invaded Ukraine in February of 2022, Nvidia stock dropped from $300 to $108. That's a 64% decline. Absolutely brutal. Anyone holding Nvidia through that period experienced serious pain. But here's what happened next. By the end of 2023, Nvidia was trading over $500. If you bought at the bottom during maximum fear, you made a 360% return in less than 2 years. If you held through the decline and dollar cost averaged on the way down, you significantly lowered your cost basis and participated in the massive recovery. Apple dropped 25% when Russia invaded Ukraine. It hit all-time highs 12 months later. Microsoft dropped 28%. It recovered to new highs within a year. Meta dropped 57%. It's now trading at all-time highs. I could give you 20 more examples, 50 more examples, 100 more examples. The pattern is always the same. Technology gets punished in the initial panic. Technology outperforms everything over the subsequent recovery. This happens every single time, without exception. Why does this pattern exist? Because technology companies are building the infrastructure for the future economy. Wars are temporary disruptions. Economic growth is persistent. The long-term trajectory of human progress is always upward. We continuously develop better technology, more efficient processes, more valuable services. Companies like Nvidia that are enabling artificial intelligence, cloud computing, autonomous vehicles, and digital transformation are positioned at the center of multi-trillion-dollar secular trends that have nothing to do with geopolitical conflicts. A war in the Middle East doesn't change the fact that every company on Earth needs to adopt AI or risk becoming obsolete. It doesn't change the fact that autonomous vehicles will eventually replace human drivers. It doesn't change the fact that data centers need increasingly powerful GPUs to process the exponential growth in computing workloads. The panic sell-off in technology stocks during geopolitical conflicts creates exactly the opportunity that smart investors dream about. You get to buy world-class companies with massive competitive advantages, positioned in the fastest growing markets at temporary discounts because short-term traders and emotional investors are selling out of fear. This is what I mean when I say never waste a crisis. The crisis creates the discount. Your discipline and patience capture the value. Now let's talk about the third pillar, strategic positioning. We understand from history that wars create short-term volatility and long-term opportunity. We understand from sector analysis that technology outperforms in the long run, while energy and defense are short-term trades. Now we need to discuss how to actually position a portfolio to take advantage of this knowledge. This is where discipline and systematic thinking separate the top 1% from everyone else. Here's the tactical game plan. First, do not go to cash. I cannot stress this enough. Going 100% cash during a crisis feels safe. It feels like you're protecting yourself. But it's actually one of the worst investment decisions you can make. Studies have proven repeatedly that missing just the top 10 best days in the market over a 20-year period cuts your returns in half. And those best days almost always come during periods of maximum fear and uncertainty when most investors have sold and gone to cash. If you sell during this Israel-Iran escalation, you will miss the recovery. You will lock in your losses. You will watch from the sidelines as markets rally without you. Don't make that mistake. Second, Avoid the obvious plays. Everyone is talking about oil and defense right now. That's a sign that the trade is crowded and the opportunity has likely passed. When something is obvious to everyone, the smart money has already positioned themselves and is looking for exit liquidity. Don't be that exit liquidity. Don't buy what everyone is telling you to buy after it's already moved. The time to buy oil and defense was months ago before tensions escalated, not now when it's the hot topic on every financial news channel. Third, focus on technology and the S&P 500. These are the assets with the best risk-reward profiles during geopolitical conflicts. The S&P 500 gives you broad diversification across the entire U.S. economy. It has a higher floor because it includes stable, profitable companies across all sectors. Technology gives you the highest upside because it benefits from long-term secular growth trends that are independent of geopolitical events. An optimal portfolio during this period would be heavily weighted toward large-cap technology stocks with some S&P 500 exposure for stability. Fourth, use dollar-cost averaging to take advantage of volatility. If you have capital to deploy, don't try to time the exact bottom. Nobody can consistently do that. Instead, buy in tranches over a period of weeks or months. When prices drop, you're buying more shares at lower prices, which lowers your average cost. When prices stabilize or rise, you're participating in the recovery. This systematic approach removes emotion from the process and ensures you're taking advantage of volatility rather than being paralyzed by it. Fifth, extend your time horizon. If you're worried about what's going to happen next week or next month, you're thinking about this wrong. The historical data I showed you earlier demonstrates that the pattern plays out over 12 to 18 months. You need to be willing to hold through short-term volatility to capture the long-term gains. This requires discipline. This requires ignoring the daily news cycle. This requires trusting the process even when it feels uncomfortable. But this is what separates investors who build wealth from investors who spin their wheels and make emotional decisions. Now, I promised you that I would reveal one specific stock that represents the perfect opportunity during this geopolitical situation. A unicorn that combines both the short-term defense catalyst and the long-term technology growth story. That stock is Palantir Technologies, ticker symbol PLTR. Let me explain exactly why Palantir is uniquely positioned to benefit from the current environment. Palantir is a software company that builds data analysis platforms for government agencies and large enterprises. Approximately half of their revenue comes from government contracts, with a significant portion of that from defense and intelligence agencies. The other half comes from commercial clients across various industries. This dual revenue stream creates a unique dynamic that no other company has. On the defense side, Palantir benefits immediately from increased geopolitical tensions. When conflicts escalate, governments need better intelligence, better data analysis, better decision-making tools. That's exactly what Palantir provides. Their platforms are used by the U.S. military, intelligence agencies, and allied governments to make sense of massive amounts of data and identify patterns that humans alone cannot see. When the Russia-Ukraine conflict began, Palantir stock initially dropped along with the broader technology sector, but it recovered faster and stronger than most technology stocks because investors recognized that Palantir was actually benefiting from the geopolitical chaos. Defense budgets increased, intelligence spending accelerated. Governments needed Palantir's capabilities more than ever. The same dynamic is playing out now with the Israel-Iran situation. Palantir will see increased demand from government clients. That creates a near-term catalyst that many pure technology stocks don't have. But here's what makes Palantir truly special. The commercial side of their business is growing even faster than the government side. They're signing major contracts with Fortune 500 companies to help them use AI and data analytics to improve their operations. This is pure technology growth that has nothing to do with wars or conflicts. It's driven by the secular trend of digital transformation and AI adoption that will continue for decades, regardless of geopolitical events. So Palantir gets the short-term boost from defense spending and the long-term growth from commercial technology adoption. It's the best of both worlds. Palantir was literally built to thrive in chaos. Their entire value proposition is making sense of complex, messy, chaotic environments. When supply chains are disrupted, when geopolitical risks are elevated, when the world feels uncertain, that's when organizations need Palantir the most. Chaos is their business model. Uncertainty drives demand for their products. The worse things get geopolitically, the more valuable Palantir becomes. There is no other company in the world with this unique positioning. Now, I know what some of you are thinking. Jensen, Palantir's PE ratio is really high. How can you recommend a stock that's trading at such expensive valuations? Let me be very clear about this. If you focus on PE ratios for high-growth technology companies, you will never make life-changing returns. PE ratios are useful for mature, slow-growth companies like Walmart or Target. They tell you whether you're paying a reasonable price for current earnings, but for companies that are growing rapidly and investing heavily in future opportunities, PE ratios are meaningless. Think about it this way. If you refuse to buy NVIDIA because the PE ratio was too high, you missed a 1,300% return over the past 5 years. If you refuse to buy Tesla because the PE ratio was too high, you missed thousands of percent in returns. If you refuse to buy Amazon or Microsoft or Google because PE ratios were elevated, you missed some of the greatest investment opportunities of the past 2 decades. Generational companies that are transforming entire industries always look expensive on traditional valuation metrics. That's because they're building for a future that's much larger than the present. For high-growth technology companies, you should be looking at different metrics. Things like revenue growth rates, gross margins, total addressable market, competitive positioning, the Rule of 40, PEG ratios, and free cash flow trajectory. These metrics give you a much better understanding of whether a company is building sustainable value or just hyped up with no substance. Palantir scores very well on all of these alternative metrics. They're growing revenue at over 20% annually. They have gross margins above 70%. They're now consistently free cash flow positive. They're winning large contracts against established competitors. And they're positioned in markets that are worth hundreds of billions of dollars. The key to successfully investing in companies like Palantir is using dollar cost averaging to build your position over time. Don't try to buy everything at once. Don't wait for the perfect entry price. Start building a position now, add to it when prices drop, and continue adding as long as the fundamental story remains intact. This approach allows you to average into the stock over time and reduces the impact of short-term volatility. Over a multi-year period, if Palantir executes on their vision, the specific price you pay today will be largely irrelevant. What matters is whether you owned it during the period when they scale from a $2 billion revenue company to a $10 billion revenue company. Let me bring all of this together into a concrete action plan that you can implement immediately. Based on everything we've discussed about history, sector performance, and strategic positioning, here's exactly what I would do if I were starting from scratch today with the Israel-Iran situation escalating. First, I would ensure that I'm not holding any cash on the sidelines out of fear. Cash is trash during periods of geopolitical volatility because you missed a recovery. Every dollar sitting in cash is a dollar that's not working for you and not participating in the inevitable rebound. Second, I would build or increase my position in large cap technology stocks. Companies like NVIDIA, Microsoft, Apple, Amazon, Google, and Meta. These are the dominant technology platforms that are enabling the AI revolution, cloud computing, digital advertising, and e-commerce. They have massive competitive moats, strong balance sheets, and they're positioned at the center of secular growth trends. When they drop during geopolitical sell-offs, that's a gift. That's an opportunity to buy great companies at temporary discounts. Third, I would allocate a portion of my portfolio to the S&P 500 for diversification and stability. You can do this through an index fund or ETF. The S&P 500 gives you exposure to the entire U.S. economy, which historically has been very resilient during geopolitical conflicts. It provides a higher floor and reduces portfolio volatility while still participating in the eventual recovery. Fourth, I would build a position in Palantir as my high conviction play that benefits from both the near-term defense catalyst and the long-term technology growth story. This would be a smaller position than the large cap technology stocks because it's more volatile and higher risk, but the upside potential is also significantly higher. I would plan to hold this for 3 to 5 years minimum and use any pullbacks to add to my position. Fifth, I would completely avoid energy and defense stocks unless I'm a professional short-term trader, which I'm not. These sectors might see short-term spikes, but they're not where the long-term value creation happens. They're distractions that will likely underperform technology over the next 12 to 18 months. Staying disciplined and avoiding FOMO when these sectors spike is crucial to executing this strategy successfully. Sixth, I would set up a dollar cost averaging schedule to deploy capital systematically over the next 3 to 6 months. Rather than putting all my money in at once, I would invest a fixed amount every week or every month. This removes emotion from the process, ensures I'm buying more shares when prices are low, and forces me to stay invested rather than trying to time the market. Seventh, I would extend my time horizon and commit to holding these positions for at least 12 to 18 months. The historical data shows that this is the time frame over which the pattern plays out. Markets bottom within 35 days and recover to new highs within 12 months. If I'm constantly checking my portfolio and reacting to daily news, I'll make emotional decisions that hurt my returns. Setting it and forgetting it for a year is a much better approach. Eighth, I would ignore the financial media and the constant drumbeat of negative news. Every day there will be new headlines about how tensions are escalating, how things are getting worse, how this could be the start of World War III. All of that is designed to generate clicks and views, not to help you make better investment decisions. The media makes money from your attention, not from your investment success. Understanding this and tuning out the noise is critical. Ninth, I would focus on what I can control. I can control my investment strategy. I can control my position sizing. I can control my time horizon. I can control my discipline. I cannot control whether tensions escalate or de-escalate. I cannot control what Israel or Iran does next. I cannot control whether oil spikes to $150 or crashes to $50. Focusing on what I can control and ignoring what I cannot is how successful investors think. 10th, I would view any further sell-offs as opportunities rather than disasters. If technology stocks drop another 20% because of some new development in the conflict, that's not a reason to panic. That's a reason to get excited. That's the market handing me an even better entry point on world-class companies. The emotional pain of watching your portfolio decline is real, but it's also temporary. The long-term gains from buying at those distressed levels more than compensate for the short-term discomfort. This is the playbook. This is how the top 1% think about geopolitical conflicts and market volatility. They don't panic. They don't chase obvious trades. They don't go to cash. They follow a systematic approach based on historical patterns that have repeated themselves for 50 years. They buy quality assets at temporary discounts. They stay disciplined through volatility. They extend their time horizons, and they let the inevitable recovery do the work. I've been investing for over 40 years. I built NVIDIA from nothing into one of the most valuable companies in the world. I've lived through countless crises, crashes, and geopolitical conflicts. Every single time, the pattern has been the same. Initial panic, sharp sell-off, relatively quick bottom, strong recovery. The investors who understood this pattern and positioned themselves accordingly became wealthy. The investors who panicked, sold out, or chased the wrong trades stayed poor or got poorer. It's that simple. The Israel-Iran conflict will eventually resolve itself one way or another. Either tensions will escalate further before de-escalating, or they'll de-escalate directly. Either way, 12 months from now, markets will likely be higher than they are today. Technology stocks will likely have outperformed. The S&P 500 will likely be at or near new highs. And investors who followed the playbook I just outlined will have generated significant returns. The only question is whether you'll be one of those investors or whether you'll be looking back 12 months from now wishing you had acted when you had the chance. The opportunity is right in front of you. The data supports the strategy, the history validates the approach. Now you just need the discipline to execute